Hey folks, Dan Frio here with your closing bell for March 7th, 2025. So what we're going to do is try to explain why today nothing really happened in the bond market or with interest rates. But we did hear from Chairman Powell. He did come out and talk today. We're going to kind of see how that's affecting these things, and markets liked whatever he had to say. Did the bond market like it? Well, no, it didn't. So we're going to talk about that briefly. And then if you're looking to refinance, like I've been asking you guys, don't miss out, because we're going to go over the charts, what happened with mortgage rates just recently when you guys missed this dip down through here, and what maybe we may be looking at over the next week or two. So let's get to it. My name is Dan Frio. Our slogan here is one application, one credit pool. We're going to shop your loan over 30 different lenders. Now, how do we do that? I'm going to give it away to you just yet. I'll give you all that information at the end of this video. Pretty intriguing, though, if you're out there looking for to buy that first house or looking to refinance. So let's get over to where mortgage rates went today. They basically did nothing. But with the expectations of Powell talking today, it's like, okay, he might, open his cards a little bit to give us what he expects to do with the Federal Reserve. I thought I would play a clip over here, and this is actually an interview that he gave today. It's a little lengthy. It's 5 or 6 minutes. For those out there that are, into this in this detail, I would highly suggest you watch the whole thing. If not, you can skip past this, because I'm going to explain how this and then the economic news that's coming out next week is going to shape the markets. So let's get over to Chairman Powell, see what he has to take on all this, and I'll just sit back here and give you my reactions to what I think. I'll let him speak, and then at the end of this, we'll put it all together. So take it away.
So I have some brief remarks about the economy and the path of policy, and then I look forward to our discussion. Despite elevated levels of uncertainty, the U.S. economy continues to be in a good place. The labor market is solid, and inflation has moved closer to our 2% longer-run goal. At the Fed, we are intently focused on our dual mandate goals given to us by Congress: maximum employment and stable prices. Turning to the recent data, the economy has been growing at a solid pace. GDP expanded at a 2.3% annual rate in the fourth quarter of last year, extending a period of consistent growth that has been supported by resilient consumer spending. Recent indicators point to a possible moderation in consumer spending relative to the rapid growth over the second half of 2024. Further, recent surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. Sentiment readings have not been a good predictor of consumption growth in recent years. We continue to carefully monitor a variety of indicators of household and business spending. Turning to the labor market, many indicators show that the labor market is solid and broadly in balance. The jobs report released this morning showed employers added 151,000 jobs to payrolls in February, and the unemployment rate ticked up 0.1% to 4.1% last month. Smoothing over the month-to-month volatility since September, employers have added a solid 200,000 jobs a month on average. The unemployment rate remains low and is held in a narrow range between 3.9% and 4.2% over the past year. The jobs-to-workers gap has narrowed, and the quits rate has moved below pre-pandemic levels. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. With wage growth moderating and labor supply and demand having moved into better balance, the labor market is not a significant source of inflationary pressure. For inflation has come down a long way from its mid-2022 peak above 7%, without a sharp increase in unemployment. A historically unusual and most welcome outcome. While progress in reducing inflation has been broad-based, recent readings remain somewhat above our 2% objective. The path to sustainably returning inflation to our target has been bumpy, and we expect that to continue. We see ongoing progress in categories that remain elevated, such as housing services and the market-based components of non-housing services. Inflation can be volatile month to month, and we do not overreact to one or two readings that are higher or lower than anticipated. Data released last week show that total PCE prices rose 2.5% over the 12 months ending in January, and that core PCE rose 2.6%. We pay close attention to a broad range of measures of inflation expectations, and some near-term measures have recently moved up. We see this in both market and survey-based measures, and survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain stable and consistent with our 2% inflation goal. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their likely effects remains high. As we parse the incoming information, we are focused on separating the signal from the noise as the outlook evolves. We do not need to be in a hurry, and we are well positioned to wait for greater clarity. Policy is not on a preset course. If the economy remains strong but inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our mandate. Before I conclude, I'll note that at our last FOMC meeting, we began our second 5-year review of our monetary policy framework. We will consider changes to our consensus statement and to our communications as part of this review. The consensus statement articulates our framework for the conduct of monetary policy in pursuit of our statutory goals. We will consider the lessons of the past 5 years and adapt our approach where appropriate.
Okay, we'll leave it at that. I've got you on here long enough. So you kind of read into that. If you notice some of the things that he said, he was saying tariffs might be short term. So we're going to look long term and we're going to focus in on that. That was a key point there. And then he also, when he started talking about the jobs market, and we have some jobs data that's coming in next week, I'll show you here in a second. That's why my concerns are people that are holding off on refinancing and so forth. I'm going to show you something here in a second. But he said, we'll cut rates if the job market starts to weaken. So we had ADP payroll numbers come in this week, and they were dismal. And then the true numbers came in. He just said there's 200,000 over the last 6 months, 200,000 jobs added a month. That is fantastic numbers when you look at it. So the job markets are starting to tighten, but here's some of my concerns. A lot of people, I talked to multiple people today, and they're like, man, I missed out on when rates, I talked to, I think 6 people today with rates over 8%. Okay. So this is one of those things, and don't take offense to this if you guys are watching, but it's where I say pigs get fat, hogs get slaughtered. If you can save $300, $400, $500 a month and your break-even point's like 6 months, refinance. And then if it comes again, if you get the opportunity to do it, you can do it again. And just be cautious of it. You don't do it way too much and just keep spending money. But if you're recovering all those costs within a certain time frame, no harm. So, a lot of people try to go from, if you go from here, you're not going to get down to here. You go from here, down to here, and then 6 or 8 months, a year or 2 later, it goes down to here. A lot of people missed out. But here's what just happened in the last, I want to say, a couple weeks or so. We had went from 7.25. Look at that rate up through there. Well, let's go down to here. Rates were just 6.7 a day or two ago. You go over to here, that's a 7.25. You have what, a 0.5% cut in rates over a pretty short time frame. So, before this bumps back up and you start kicking yourself in the head saying, man, why didn't I do it this time again? Give us a call. I'll give you all my information at the end of this video. So here's my concern going into next week. We have, when they were talking about the jobs reports, the JOLT index is coming out on Tuesday. This is job openings and labor transfers. That's some of the biggest news that we're going to get out. That'll tell us, where people are going, what's the job market looking like. And then we're going to go over on Thursday and we'll see the initial jobless claims and the producer price index that's coming out on Thursday of next week. So my concern for next week is just basically oh man, I just missed this. The CPI. Wow. I was looking down here at a second. I'm like, I see the PPI. Where's the CPI? So next week we have some major inflationary numbers coming in. So Tuesday is the JOLT, how many openings there are there. And then we have the consumer inflation numbers coming out. That's the C on the front of the CPI. Down on Thursday, we have producer inflation coming out, and that's the P on the front of that. So think of PPI as producer, CPI is consumer, the C and the P. So that data is coming out. If this thing shows any heating up in the market at all, you heard Federal Chairman Powell, we start seeing inflation heating up, we will increase rates. So where this is going to go from here, it's hard to tell. They're analyzing over here saying month over month, inflation is going to go from 0.5 to 0.3. And then here 0.4 to 0.3. But if we miss these estimates, like we've seen over the last couple of weeks, if we miss, it's completely bad news in the markets. So hopefully these numbers keep coming in favorably for us, and we might see more reprieves in rates. But there's more of an upward risk in rates right now, I think, than a downward trend. So that's why we're reaching out to people. If you have rates 7.5 or above, look to save some money right now. So let's go over for conclusion. Mortgage rates were completely flat today. We had a good rally Monday, Tuesday, Wednesday, and then it just petered out from there. Federal Chairman Powell just spoke. The equity markets are loving this. Oil, the VIX is coming down. That's anxiety levels coming down a little bit, which is fantastic. Go over to oil. It's still below $70 a barrel. We're good there. Let's just for kicks see what crypto's doing. 85. This will be at 90 probably by Monday. Who knows? So that's what we're going to see for there. But next week's news, it starts coming out on Tuesday. No real information for us on Monday, but I'll be back here at the opening bell on Monday to give you all this information. So who am I and what do I do? Well, what is going on here? They are working on my website in the background, but there it is. If you need some assistance from me, how do we do that one credit pool, one thing, 30 lenders? Basically, here's what I do. I'm actually a loan officer at a federal bank. Okay, this federal bank, though, is unique because what it allows us to do, and I'm helping them grow, is we have 30 other banks, lenders, credit unions, mortgage companies over here. We can use their programs, their rates, their down payment assistance programs if they have them, everything. So if I don't have the program or maybe they have a better rate, I can do for you. So my goal is if you're out there trying to find that dream house to move into or work with somebody that can help you with a refinance, I'd love to help. If you just want to do this on your own, you don't need any help, go ahead and do it. But if you really need our help, I'd love to help you. How do you reach out to me? You just go to therateupdate.com. Here's my website. You can click apply now. That application will come right to me. I'll get you on the phone within probably 24 hours and go over everything with you. You can schedule a consultation with me right up through there as well. Or you can skip the line and give us a call. Right down here is our 800 number as well as my email. Right through there. So if you want to give us a call, just call right there. But if you do want to reach out to me personally, and I talked about 5 or 6 people today, and they still get a kick out of it. They're like, I didn't think you'd call. Yeah, folks, I do call you. So shoot me an email right through here at dan@therateupdate.com. Give me your question, your situation, and your contact information. Be more than happy to call you back and help you work that out. So thanks for watching. Have a fantastic evening. God bless. And I'll see you over the weekend with Stock Talk. And I'm also going to come out with the economic calendar for next week. Just prep you guys. So thanks a lot for watching. If you haven't subscribed yet, please do so over there. Thanks for watching. See you next time.